Howdy, everybody. Welcome to Liberty Call. Today is Friday, June 20th, 2025. Hope you're having a fantastical day out there in the interwebs. It's a very nice but warm day here in the Rockies. So pray for us so we don't melt. So not as bad as it was last weekend, but it's going to be toasty. They have down in Denver, they've got, I think they're going to get up to 100 today and tomorrow. So they're all global warming. So anyways, well, markets were mixed coming off the Juneteenth break. Hope you had a good holiday if you were off yesterday, with investors juggling weak economic signals and geopolitical uncertainty. The Dow managed a modest gain while the S&P and NASDAQ slipped. Recession concerns grew as the conference board's leading economic index fell for a sixth straight month. Meanwhile, oil dipped on delayed U.S. action in Iran, and the Fed remains split on whether to cut rates in July. So before we break all the news down, and you can see my deputy director of security back there taking a break, I need some help from you. Give me some thumbs up, a like, share, subscribe, a follow, and press that notification bell. All righty, well, let's get into the markets, see how they did today. Dow Jones finished the day up 0.08, 35 points, closed at 42,206. S&P 500 down 0.26%, 15 points, closed at 59.65. NASDAQ down 0.51%, 98 points, closed at 19,447. The VIX was down 6.95% today. It's at 2063. Canada down 0.03, Brazil down 1.14%, and Mexico up 0.29. In Europe, Germany was up 1.27%, the UK down 0.2%, France up 0.48%, Netherlands down 0.09%, Spain up 0.77%, Italy up 0.74%, Switzerland up 0.23%, and Portugal up 0.71%. Russian exchanges in the red today. The MOEX down 1.25%, RTSI down 1.28%. And the overnight markets, the Nikkei in Japan was down 0.22%, Australia down 0.21%, New Zealand was up 0.28%. In China, the Shanghai down 0.07%, Shenzhen Component down 0.47%, China A50 up 0.35%, DJ Shanghai down 0.09%, Hang Seng up 1.26%, and the Taiwan weighted down 1.58%. All righty, good stuff. Let's jump over to the markets and see how they did for the week. All right, get that off the screen. And there we are. Okay. There. All right. Starting out with, let's see here. We're starting out with the Dow. Looks like it's going to finish the week up 0.02%. So basically flat. So had a nice Monday and then just kind of lost steam the rest of the week. Let's see, S&P 500. It's going to be red by about 0.14. NASDAQ up 0.19. The Dow Transports, there we go, up 0.58. And the Dow Utilities, let's see here, up 0.06. So all in all, a pretty flat week for the markets. Let's zoom out and take a look and see what the year's looking like. Starting here's the beginning of the year right here for the vertical line. So again, we had a nice little uptrend heading into the inauguration. Lost its steam through February, March, and April. About halfway through April, had another uptrend and broke the downtrend. And we've been sideways for the better part of 28 trading days, or about a month and a half. So curious to see what's going to happen here. What I would say to pay attention to if you're a amateur trader out there, watch consumer spending. And secondly, watch the jobs numbers. I think spending will probably show weakness first, followed by the unemployment numbers and the people filing for unemployment and long-term unemployment. So those will start to tick up, I think, second. Beyond that, I'm not really sure what other metrics you might want to, really pay attention at, because again, spending runs the economy, and then jobs, is kind of secondary to that. So if spending slows, jobs will suffer, and then I think it kind of creates that vicious cycle moving forward. So, all right, let's get that off the screen. Let's get to the economic data for the week. Initial jobless claims came in at 245,000. Forecast was 246. Previous number 250. Continuing claims came in at 1.945 million. Forecast was 1.94, so 5,000 over forecast. Previous number was 1.951 million. Retail sales year over year grew at 3.29%. Previous number was 5%. Month over month actually contracted by 0.9. Forecast was a contraction of 0.5. Previous number was a contraction of 0.1. Industrial production year over year grew at 0.6. Previous number was 1.43%. So it's trending down a little bit right now. Industrial production month over month contracted by 0.2%. The forecast was flat at 0. Previous number was up 0.1. Business inventories month over month were flat. Same with the forecast. Previous number was 0.1. And the National Association of Home Builders Housing Market Index came in at 32. The forecast was 36. Previous number was 34. So the confidence index has really been slipping most of this year. Housing starts came in at 1.256 million annualized. Forecast was 1.35. Previous number 1.392. And I mean, as you can see here on these candlesticks, they've been jumping around quite a bit on these bar charts. Month over month, housing starts contracted at 9.8%. Previous number was 2.7% growth. Building permits came in at 1.393 million annualized. Forecast 1.42. And previous number was 1.422, down a little bit from last month. And on a month-on-month, it contracted by 2%. Previous month, it contracted by 4%. And the U.S. leading index month over month contracted at 0.1%, right on forecast. Previous number was a contraction of 1.4%. And that is all. All right, good stuff. All right, well, let's next up get into the market recap. S&P 500 gives up gains as stumble in chips offset rate cut hopes. Alrighty. The S&P 500 ended slightly lower Friday, giving up early gains as losses in chip stocks overshadowed dovish comments from key Federal Reserve officials. Markets have been cautious all week following the Juneteenth holiday and uncertainty around the global trade and geopolitics. Semiconductor stocks like NVIDIA and Broadcom led declines after reports surfaced that the Trump administration plans to revoke waivers allowing U.S. semiconductor equipment exports to China. The new rules would align with China's licensing approach to rare earth exports, but they're not considered an escalation according to U.S. officials. Of course not. Meanwhile, Fed Governor Christopher Waller suggested that a rate cut could come as early as the next Federal Reserve meeting in July, citing soft inflation data and downplaying the inflationary impact of Trump's tariffs. I could pause here. Highlight that so I know where to go again. From the Fed from Chairman Powell's conference the other day, if you read between the lines, he seems to think that inflation is going to pick up on the second half of the year, and that we'll end the year at around 3% inflation. So I'm really not sure what Mr. Waller's talking about, because if you lower rates now, that'll actually accelerate inflation heading into the year. So, I mean, as it stands right now, with everything as it is, they anticipate inflation is already going to be higher than where it is today. So why would you lower interest rates, especially when we don't have some black swan event or bear market or anything like that going on right now? So anyways, that's just my 2 cents. This contrasts with the Fed's earlier decision to hold rates steady, prompting criticism from Trump, who accused Chair Jerome Powell of costing the U.S. hundreds of billions, and that's in quotes. Well, maybe if we hadn't ran up $37 trillion, we wouldn't be in this mess. Geopolitical tensions also weighed on sentiment. The White House announced that President Trump will decide within 2 weeks whether to join Israel in military action against Iran, keeping the Middle East conflict and oil price volatility in focus. Again, if I could jump in here, I think any aggression on the U.S. part should immediately trigger an impeachment against President Trump, and the man should be jailed for war crimes. But that's just my take as a veteran and a taxpayer. Let's see here. On the corporate front, Apple is accelerating its shift to Indian manufacturing in response to U.S. tariffs on Chinese goods. Accenture stock dipped despite upbeat earnings, while CarMax surged on strong quarterly results. Darden Restaurants also rose after boosting its dividend and approving a $1 billion share buyback despite weaker guidance. Overall, investors are navigating a complex environment of trade uncertainty, interest rate speculation, and rising geopolitical risk, with upcoming Fed action and global conflict resolution playing key roles in shaping market direction. It's a mess out there, folks. What's funny, and like I've kind of, talking with clients, it's kind of boring from the, looking at the statistics and the data that go over during, service meetings with clients, and there's not a whole lot of excitement there. All the excitement's, globally, and the, the crap going on here domestically. So, all right, let's get to our next article here. This comes from Zero Hedge. Did the Fed just predict a recession for later this year? This was authored by Mr. Mike Shedlock of mishtalk.com. Really good follow on Twitter if you're a Twitter type person. He has tons of good data. The Federal Reserve's latest projections suggest that a recession may be on the horizon, even if officials avoid using that word. According to its summary of economic projections, the SEP, the Fed now anticipates 2025 GDP growth of just 1.4%, a downgrade from the 1.7% forecast in March. While that may not seem alarming, historical data shows that 10 of the last 12 U.S. recessions began when year-over-year GDP was still positive, averaging around 1.2%. Analyst Mike Shedlock points out that since 1948, only 3 times has GDP dropped from over 3% to 1.4% or lower without a recession following. So 3 times. Yeah, but what's the denominator? I mean, we know the 3 is the numerator. So this context makes the Fed new forecast a potential warning sign. Shedlock criticizes the Fed's history of attempting to avoid recessions through interventions, which he argues has created asset bubbles and housing inequities. I wholeheartedly agree. He also takes aim at the Fed's continued reliance on the Bureau of Labor Statistics data, asserting that Chairman Jerome Powell is underestimating the risks in the labor market. Further compounding concerns, the Fed has forecast higher inflation and unemployment, attributing some of this to tariffs under President Trump's policies. Shedlock warns that between Powell's missteps, Congress's inflationary spending, and Trump's tariff agenda, the U.S. economy may face significant turbulence ahead. So, well, it wouldn't be the first time that those in charge have created more chaos out of a bad situation. All right, next up, also from Zero Hedge, is the dollar's death greatly exaggerated? This was written by Lance Roberts via realinvestmentadvice.com. So that's something I worry about. All the social crap here in the U.S. To me, it's fiscal and insolvency, debt. Those are the things that I think will really bring down the empire. Let's see here. The dollar death, that's in quotes, narrative has resurfaced in financial media, driven by recent declines in the U.S. dollar, trade tensions, and geopolitical noise. However, as Lance Roberts argues in realinvestmentadvice.com, these fears are exaggerated and often driven by emotional narratives, not economic fundamentals. Roberts lays out 5 key reasons why the U.S. dollar remains secure as the world's reserve currency. First, no viable alternatives exist. There's nowhere to go. It's kind of like, the last election in November. You had Kamala and then you had Donald. So it's like, who's the worst piece of crap out there? So, I mean, I went with Donald just because the left is just so out there these days. I just can't agree with anything that they propose. All right. The euro is politically fragmented. The yuan is tightly controlled, and other currencies lack the scale and liquidity needed. Second, the U.S. economy still dominates, making the dollar a haven in uncertain times. Third, global network effects ensure the dollar's dominance in trade, debt, and FX markets. Fourth, de-dollarization efforts like trade in yuan and gold reserves remain fragmented and symbolic. Lastly, despite criticism of U.S. policy moves like tariffs or sanctions, the dollar continues to serve as the global financial backstop. Roberts also noted that the dollar may be poised for a rebound. The currency is oversold, and speculation against it is at record levels. Additionally, diverging global interest rates like the ECB's aggressive cuts make U.S. Treasuries more attractive, driving demand and supporting the dollar. Ultimately, fear-based narratives around the dollar's collapse are popular because they trigger deep psychological biases like negativity bias and loss aversion. Media outlets amplify these fears for attention, but long-term data and historical patterns show that staying invested has been the better choice. The dollar may fluctuate, but talk of its demise is premature and overblown. Yeah, I mean, in reality, the worst thing that happens to the dollar is just the devaluation of it. And the good news is that the other major currencies are doing it worse than we are. So it's kind of like the tallest midget in the room. It's like, hey, you're gonna be the number one draft pick for the midget basketball league. So, all right, I got one more article here. We've talked about we talked talked about recessions, dollar collapse. Now let's move on to gold because Mr. Peter Schiff is always happy to talk about that. So, also from Zero Hedge, Schiff, why is gold still king? And he loves this stuff. So let's see what he has to say. Despite gold's long history as a store of wealth, mainstream financial advisors often downplay its value, recommending allocations of less than 10%. This skepticism is rooted in a modern bias, the belief that high returns with minimal risk are not only achievable but expected. Advisors tend to favor electronic or speculative assets that promise quick gains, catering to client expectations shaped by a historically rare period of exponential economic growth. Yeah, typically markets don't jump like they have the last 10 or so years. However, the mindset assumes the current economic system is sustainable indefinitely, a risky assumption. Gold offers long-term stability and protection against systemic shocks such as war, natural disasters, or economic collapse. While physical gold lacks the liquidity and convenience of digital assets, it's far less vulnerable to cyber attacks and technical failures. Selling gold may take more time, but it remains a secure, tangible form of wealth preservation. The belief in unstoppable progress blinds many to the risks of bureaucratic overreach and government malinvestment, both of which threaten innovation and long-term prosperity. As history has shown, no economic boom lasts forever. In such an uncertain world, dismissing gold as outdated ignores its real value. Financial advisors would better serve clients by recognizing gold as a prudent hedge, not just for preppers, but for anyone with an eye on risk. All right. Well, I think the folks that I service are real happy that we've had gold in our portfolios. It has certainly been, a nice backstop for the volatility. So, not telling anyone how much to buy or if they should. This is just anecdotal. But, anyways, certainly good stuff out there. All right. Well, that is everything that I had to talk about for today. So if anyone needs anything from me, where do you want to go? DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a call. I'll be glad to help. Hope everyone out there has a wonderful weekend. I got some chores on the horizon, and hopefully we'll survive the heat wave this weekend. It's going to cool off on Monday with some storms. But anyways, like I said, hope everyone out there has a good weekend, and I'll talk to everyone again next time. Adios.